All right. Good morning, everybody. Busy day. Uh, they say banks really set the tone for earnings, but it really feels like this time around the Mag 7 is going to be setting the tone. Now we all know that the Mag 7 can move markets. I mean, that's not new, but it's not normally attributed to them for the tone of the market. And I think Facebook summed it up really good when they said all this AI stuff is going to cost us money and we can't monetize it right away. And you're just going to have to suck it up and take it. And the market kicked them to the curb. We might see a lot more of that. And if you've heard my morning briefings for a while, I've mentioned more than once how companies, any company who's mentioned that they're dabbling in AI, uh, has had a bad earnings afterwards when they've not been able to show an immediate monetization of that AI. As long as they haven't claimed any sort of AI spending, then they haven't really had that sort of punishment afterwards. And the first one of those that I saw that really stood out to me was Adobe. But I like how Facebook handled it. And it's not the first time where Facebook has gotten punished for its spending. Uh, it gets into oddities like the glasses and the metaverse, and it seems like it's always getting in hot water somewhere, even when they have amazing revenue. If they tamper with their spending or say that they're going to spend a little bit, they get the beat down. And it wasn't any different this time. My short was a put spread using 425, 400 puts. And if it holds these lows into Friday, that ought to monetize pretty good. It was just $3 in debit, which leaves $22 as potential profit. I doubt I'll see that. As I mentioned the other day, my mistake with that trade is I should have put more time on it, but it was a lotto. I don't like spending a lot of money on a lotto. So kind of a little bit of a catch 22 on that. If we look at what's going on around the world, Europe is up. Japan is green. Catch that, right? Hey, a green day. We knew it had to happen sooner or later. Dow down a half of a percent, the S&P down more than that, and the Nasdaq down 1%. Now, Hong Kong is green, barely, and small caps also are green, barely, just hanging on a little bit. Now, the market's tried to bounce back, but there's still this big worry because we've got more Mag 7 on the way, right? We're not done yet. We're just getting started. So, got to temper those expectations a little bit. If we look at upcoming earnings, we've got a number of things, including uh, outside of earnings. GDP. Now, yesterday there was GDP revisions. The Atlanta Fed GDP went from a 2.9 to a 2.7. Looking at the founder's note from Spot Gamma, it has today at 8:30 as GDP. So we take a look at Market Watch. There's April 25th, 8:30, Q1 GDP. The previous was 3.4, and the forecast or the estimate is 2.2. The markets aren't going to like that. We're going to get some jobs data. This isn't the jobs data, the big one. It's non-farm payrolls. This isn't that, but it's still going to be a small glimpse into all this effort the Fed has put in to trying to slow down this market a little bit. Are they in restrictive territory? And if they're not, how much farther do they have to go? Now, we've shown this graph more than once. I don't show it every day because it doesn't usually change enough on a day-to-day basis to warrant doing this. But if you've never been to this site before, get familiar with it. It's free, doesn't cost you anything. You can Google it, CME Group. You can just type in Fed Watch Tool. It's usually how I find it. Just type those words, Fed Watch Tool, and you can come to this website. If you've never been here, it can look a little intimidating. Just take your time, push the buttons a little. You can't break anything. It has the Fed dates here in white, and then the gray ones are next year. And I've seen them change these dates before. So in my belief, it's grayed not just because it's next year, but also because those dates might not be set in stone, that it might adjust. You can see how things have changed over the last 24 hours, over the last week, and over the last month. Yeah. It can be a little confusing if you aren't familiar with this. The easiest way that I recommend reading it is just to ignore one number. So you can say the current rate is 5.25. You could say the current rate is 5.5. You don't need to split the difference and say it's 5.25 to 5.5, because that just confuses people. If that's our current rate, and right now the probability is in 96% that at the May 1st meeting, it will continue to be 5.25, meaning right now they are not projecting a rate cut. The market isn't pricing in a rate cut, but it's also not pricing in a rate hike. We can look down below and find those same numbers. Right now, it's at 96%, which we already know because it says it right there. Yesterday, it was at 96.5. So it actually fell down just a tiny bit. A week ago, it was at 96.8. And a month ago, it was a 90% chance. So over the last month, they priced in a little bit more the idea that we wouldn't do anything. That's not much of a surprise. They've been really beating that drum saying we're not cutting, but we don't see any threat, so we don't need to raise rates. But what about June or July? Where does that rate cut start to actually show up in here? And is there more than one rate cut being priced in? Well, here's September, and it's the first time we actually see a rate cut with a higher probability than any of the other probabilities, all the way out to September. Well, if we start cutting in September, that doesn't leave us very much room for a lot of cuts. Remember when we came into this year, they were talking 6 cuts. Now it's maybe 1. That big difference, and that's part of the reason the market took this gut punch and pulled back the way that it did. So again, reading it just using one number, we can scratch that 550 off and say that the current rate is 5.25. That would be this right here. So scratch that first number off. There's a 46% chance that we'll get a rate cut in September. And that's a higher probability than staying put without cutting, or that we would have 2 cuts by then. Take a look at November. Also has probability of us being at 5.25. Now you can read that as that would be the first cut, or you could read that as they would hold after they cut in September, not projecting another cut. And now we can see in December that they're projecting the second cut, going from a hypothetical 500 at that point down to a 475. Right? So September and December right now are the ones that you would really want to focus on. It's not like you got to stare at this thing all day long. Just keep your eye on it from once in a while. Take a glance at it. If you hear, as we all hear from time to time, oh, they're pricing in a cut. Oh, those numbers are going to make them rethink the rate cut. you can come in here and look. You don't have to take their word for it or wonder how old that statement is that you might have read somewhere. Just catch it yourself by coming in and taking a look at this. And there are more choices here that you can play around with. Not really going to get into that at this point, but the Fed Watch tool, certainly something you want to be more familiar with. We do have a full day today, but tonight is a really big deal as well. We're going to get a lot of data out of Japan, and that has to be, front and center into our concerns and our worries. If we look at FX Street, for an example, we can see tonight we're going to get CPI in Japan, and CPI is a big deal, whether it's in the US or Japan, Europe. So it matters. If you're swing trading, you really want to consider how this might affect the broader market. And you can see for the day, we've got just a ton of economic events all through the day, including auctions. Now, these are still up in the front end, but they are auctions of concern. And we had a record auction on the 5-year the other day. So even these front end ones are really worth your time and attention. And at the very least, just look at the clock, keeping track of what time it is if you're day trading, because the time of day greatly affects what we expect out of the market. It's one of the best indicators that you can get, and it's free. It's the clock. There was another article, I was hoping that it would show up here, that talked about how Meta may just be the front runner for an entire earnings cycle where the Mag 7 gets kicked in the face. But I don't see it here. I'd have to go track it down somewhere. And really, it's just putting out that hypothetical of what if this is, the first of a series of Mag 7 with bad earnings, and what would that look like in the market? Just keep in mind that a lot of this sell-off is nothing more than the warm, fuzzy feelings disappearing. We don't have those earnings from the other companies yet, and things can pop, move right back in the other direction really quick if sentiment changes, and that can change for a ton of reasons. We don't even have to wait till the end of the day with an earnings announcement from another company. The market can just start to get that warm, fuzzy feeling again. It's not like something has fundamentally changed, or, that something has happened other than one company, Meta, getting that earnings announcement. Here we can see on the right side of Finance Juice, major earnings estimates. This is not all the earnings. These are just some of the biggest names that are reporting earnings. Google and Microsoft are a really big deal. Make no mistake about it. And Intel, I mean, it's no joke, but Google and Microsoft, really, they're the big ones to pay attention to. We also have a lot of data coming out of Europe. It's been coming in. We're going to continue to see it come in. And keep in mind, if Europe is the reason that we popped up off of these lows, then once Europe closes at 11:30, we could just as easily fade right back down again. So something to keep in mind. We didn't keep our missed daily pivot from yesterday. We went down and tagged that, so we don't have that classification from yesterday to put onto today's analysis. But here we are yet again this morning with another MDP, missed daily pivot. We had one yesterday, which we ended up hitting anyways, but we're starting the day with one again today. The difference is yesterday we were above it. Today we're below it. It still won't count until tomorrow, but it is worth keeping an eye on. Where's that daily pivot? Are we above it? Are we below it? Have we hit it yet? The volume is still sitting up in the high 90s. This continues to impress me. I love seeing all this volume. It's been a while since we've had that level of trading activity. And this is supposed to be, a slow time in the market. It's not what we're seeing, right? Not what we're seeing at all. Now, it is a little lighter than the yesterday, but it's better than it was Tuesday. So if you look back how the first 3 months were, we were sitting in the 60s and the 70s. So this is really great being in the high 80s, 90s, 100s. It's cumulative overnight volume. So not really representing, is it buying volume or selling volume? It's just volume. There was trading in the overnight. There's always this discussion too for new traders when it comes to wondering if they can trade at nighttime. I've talked to people who, traded penny stocks for a long time or only traded equities, and now they want to trade futures and they're worried about like a low float. You don't have to worry about that. If you want to trade at nighttime, you don't have to worry that there's not enough liquidity to get something traded. There is the lack of movement, right? Because if there's just nobody trading, then there's not much to it. But keep your eye on the clock and the different markets that are open around the world. There's actually a website for that. If you don't want to use the website, there's Thinkorswim. You can use the home screen. It has markets from around the world, and you can set that. But there is enough trading in the overnight hours that you don't have to worry about a lack of liquidity. And this cumulative overnight volume certainly looks really good. We're still holding above that weekly pivot point, but we're back down to it. Now, I'm not overly concerned with that. When we break through any sort of resistance, whether it's a hypothetical resistance like a pivot point or a more concrete resistance like previous day's high and low and that sort of thing, it's still just a pivot point. When we break through a resistance, very often price goes back and validates that old resistance as a new support. I call that Busby. This would be a really big Busby, but it's still the same concept, right? We had resistance. We tried multiple times to break through that weekly pivot point. We finally got it. And now we're coming back and retesting old resistance as new support. That's not too concerning yet at this point. What would be concerning is if we break that pivot point and get below it. Then we're looking at a scenario where we've broken down more of a fake breakout fast failure sort of concept at that point. If we break the pivot point, we'll also have to worry about the put wall, which is at 50.36. It's laying right on top of our ADR lines. So if we were looking at this and we wanted to, have a consideration for ADR, let's just use this chart. Makes things a little easier when there's nothing here that we don't have to look through all the other indicators. So ES 5-minute chart, extended hours. We can see the ADR lines, both the red on each side. We're hovering not perfectly in the middle, but we're not heavily tilted to one side, right? If we were at 50.90, we'd be really close to the upper edge. We'd say we're going to the upper edge. If we were sitting at 50.50, then we'd be much closer to the lower edge. We'd say we're probably going to the lower edge. But we have a lot of the same features of yesterday, the same setup, the same approach from yesterday is going to be today's. We're kind of sitting in the middle of these two lines. We don't really have a bias yet, one direction or another. Market's trying to recover from meta. And all we have to do at this point is just GTFO out the box. If we break the upper edge, we'll go to the red line above. If we break the lower edge, we'll go to the red line below. I know how generic that sounds. And no, it sounds easy, but it's not easy, right? You have to hold on through all of that. But I would argue that you don't necessarily have to hold on through the whole move, right? You don't have to capture the whole play like yesterday. I gave you guys the same setup yesterday with the same rules and the same focus. All we have to do yesterday was either break the high and we'd go to the upper red line or break the low and we would go to the lower red line. That's how we ended the stream yesterday. We finally got our breakdown and we went down to it, but it was not a straight shot, right? We had some reasonably decent pullbacks, things that wanted to shake up our analysis and make us change our mind. But we did eventually get down there. So we've got the exact same thing today. We need to break out of the box. And once we do, we can go to the low end or we can go to the upper end. That's it, man. It's pretty simple. Just don't feel obligated to take the entire fight, right? There's always that phrase of, well, actually, I'm not going to use that phrase. It's not good for public television. But basically, you take big bites of something, you know, garbage in, garbage out. Anybody who's read a couple of trading books has heard the phrase, eat like an elephant, then you do something else like an elephant. So why not take just smaller bites? You've got a destination in mind. You would want to look for short setups that get you a high conviction trade, close it, and if you see another one, then take another one that you don't have to try to hold for the entire. Right now we're doing a VWAP zipper. What we got above is what we're getting below. We're just bebopping back and forth here, building up like a little bit of a megaphone pattern, waiting on data, waiting on the market to pick a direction. So even VWAP doing the same thing. We're just holding this zone, holding the range, waiting on data. This is a weekly chart. We failed that halfback, got back down below it. We're still close enough to it that we want to keep our eye on it. 50.88 is that halfback. For the bigger move, the halfback is 51.50. We're still a long ways from that. We haven't even tested it yet. So the thing about testing a moving average like this, and we've seen it before, when a market hits a resistance that it can't get through in regular trading hours, one of the things that it will do is jump that moving average or resistance after hours. So that's something to think about. But this is a weekly moving average. A weekly 10, however, is like a 50 daily. It's not perfect, but when you see a weekly 10, you can just consider it a daily 50. So if we're fighting against a daily 50 in the regular trading hours, it's not a surprise if we jump that daily 50 after hours. We still have a gap to fill down below. And as long as we're still holding higher than the previous week's low, then everything is fine. Now, we talked about this potential recovery the other day and what it's going to take or what it might look like. But there's a concern to all of this. And I'll just back up to around this time frame to have that conversation. Once we've set this high and we've pulled back, we can measure the distance between these two and lay out a halfback line. We can even get above that halfback line. But if we fail to set an equal high or a new high, then what we end up with is a lower high. And that's not good. Now, once we've got that lower high, it then becomes really important that we hold that low. If we don't, and we break that low, now we've got two lower lows and a lower high, and we'd be looking for another lower high. That's a full set, two lower highs, two lower lows. That's a confirmed downtrend. So whether you're using pure price method or you're using moving averages or any combination of the two, right now, just getting through that halfback is only part of it. And there's still a really big threat to us if we don't come back and at least make that equal high. That's a little farther down the road, but the clock is ticking. Next Wednesday is FOMC and QRA. Next Wednesday, snuck up on us. It's really quick. So not only do we have all of the FANG stocks or the Magnificent Seven set to report but we've also got QRA and FOMC. So the death cross by itself is really no different than any other combo pair. It's popular, but depending on the time frame that you're using or which analyst book you might have gone through, one of a bigger one is a 10-20 cross on a weekly. That has, well, I guess it also depends on whether you're discussing futures or equities, but that's a big deal. The 10-20 cross on a weekly is a confirmed trend reversal. And if you take that, put it back on a daily, talking about like a 2050, it would again be a confirmed trend reversal. But a 2050 cross can take so much time that you'd want to pick your poison and either go with the pure price method, which would get you that confirmation sooner, or use a combination of the pure price method and the moving averages. But it's just a confirmation of a trend reversal. Most of us get to that confirmation long before the 50 and the 20 cross. You know, it's almost like the analogy of, or how much more can you do? If you hammer a nail in until it's flat, you can continue to hammer that nail, but you're not going to get it more flat. Once you've called the trend reversal, it's a trend reversal. How many more signals do you need to confirm that it's a trend reversal? Yeah, pure price would just be that you're only using the candles, right? That you're not using moving averages, rate of change, MACD, stochastics, that sort of thing. Pure price is what they teach when it comes to, lower highs, lower lows, higher highs, higher lows, continuation through candle patterns only. And that's where it gets its name, pure price. Pure price can let you down. It's not the end all be all of everything, which is why most people try to do a little bit of both. Use the pure price, but then also try to back that up with some measurement from an indicator, because indicators measure things so much better than our eyeballs do. Rate of change, the slope of a curve, the slope of a moving average, measurements of increasing or decreasing volatility, momentum, trend. So we got the 10-day, 30-minute volume profile and the TPO. If you haven't seen this before, you're kind of new around here. The blue one might look like a volume profile, but it's not. The green one is the volume profile. The blue one is TPO. It's an acronym, time, price, opportunity, TPO. Just consider it volume by time rather than volume by price, because that's what a volume profile is volume by price. Now, yesterday I added the spot gamma indicator to this just because we were looking for, where's the put wall and all of that. And on this time frame, I think it really does help a little bit to see how we're pinched kind of tight between that call wall and that put wall. Usually we're a little farther away than that. They rolled the put wall up, which is considered a bit bullish. But now we've got both of these near us. And one of the things I had mentioned yesterday was that if we were going to continue that drive to the upside, we would want to watch and see if 5130 was being traded out in the ES. If we were seeing a lot of options activity around that 5136 area. But we didn't even hold that price range, let alone challenge that call wall, and we faded away from it anyways. We've still got the point of control near us. That happened when we lost more of this volume as the day went on yesterday. And right now, we have to consider that we are in the area to reinforce more volume on this point of control. So it's not going to move anytime soon. That point of control is locked there for a while. And the only thing that could significantly change the shape of this profile in the near future would be if we expand lower or break out higher. We're not even going to really compress much until next week. Throughout the day today and then through Friday, we're going to lose this upper volume area. That'll cut us down what, another 50 points or so. And by next week, if we haven't broke out and started moving to the upside, we're going to have a very narrow profile that'll look about like that. I know that's probably hard to see. Maybe if we just stack a couple up there. There we go. Make it a little bit brighter. We're going to lose all this to the left. And if we don't break out above that call wall and go higher by next Monday, then this zone will be our new volume profile. That's a pretty narrow zone. We've seen it more narrow than that, but that would be a pretty compressed market. The thing about a compressed market is the energy that it's building up. We can wind up a lot of energy staying sideways. Then when the break finally comes, oh boy, it's a doozy. So we did have the VPOC from yesterday. It almost got hit in the pre-market when we were marking it yesterday. We already had that near miss. In the RTH yesterday, we ran right through it like it wasn't even there. But the market did pull back up into it on the other side. Price will sometimes not respond to these lines at all, and it will act like there was never anything there. Usually, you'll see something though, and you should see it on the dome. You should see orders around that area before we fall into it. And even after we cut through it, there's a phrase called pulling and stacking. You should be able to witness the restacking of those positions once we've cut through it, which generally helps with the question, have we taken out all of that liquidity yet? I used to believe that once we cut through a level or a zone or a line, that the liquidity's gone. We've cut through there. There can't be anything left. But that was ignorance on my part. I didn't understand. If you think of a firm that has a goal today of 10,000 contracts, they're not going to put 10,000 contracts on the dome. They're going to load it up with a couple hundred. And if those get taken out, then they'll put some more on there, and then they'll put some more on there. So if I was a firm and I had 300-400 contracts sitting at 5106 and we cut through it, then we pull back up into it. Well, once we're through that, I can put them back on the dome. Price isn't trading right there. Put them right back on the dome. Then price pops back up into that same spot, and hey, there I am, and I get to fill a couple hundred more. So the idea that liquidity is gone, that we've gone through that zone and now there's no more liquidity, that's not always true. So you want to watch the dome to see if they're restacking. Jigsaw makes that really easy. But even Tradevate has a column on the dome called pulling and stacking. So you can put that on in your Tradevate. Tradevate used to be partnered with Jigsaw Trading. So Tradevate's actually got a lot of order flow tools built into the platform, which is kind of cool. If you are just learning order flow and you don't want to go buy something like Bookmap or Jigsaw. Either way, we don't need this point of control anymore. We're done with it. I should have kept that. We built a new point of control yesterday, and it's worth noticing where the volume was from that point of control, the one that I'm marking now. We always want to ask the question, where is the volume? Is it in the upper part of the day or in the lower part of the day? And then where did price close? Now we had a pretty violent ending thanks to Facebook. You could imagine that if Facebook hadn't reported negatively, then the ES would have popped above this VPOC and we'd have closed up here somewhere. So if there was no earnings at all, then you could believe that we'd have closed just underneath the VPOC and it would have just been a reasonably decent compacted day. But that's not what we got. So we do have the VPOC, and it is a cog line, 5111. If we make moves to the upside, we're going to have to deal with that. And as for where the point of control is in relation to price, this is more of what the conversation is supposed to be about. that we had a day where price made a really good move, and the volume profile shows the point of control in the upper portion. For yesterday, it's more of a lump. Look at the profile itself. It's got like that classic D shape rather than a classic T shape. That's where those shapes really start to come into play. I know we talk about them on the 10-day, 30-minute too, but they're just as valuable on the 5-minute. So in that classic D shape, with the point of control being in the right spot on the D as it should be, just gives us our VPOC. We're lined up. And it means that all of a move, any move back above this Globex range that we've already set this morning, it will be a fight all the way up into and including that VPOC. There's no tail like that back here. Since it's a classic D, basically the whole thing is just going to be trouble the whole way. No, if you want to look more into volume profile, I think Jim Dalton probably be the look his books up. He goes into TPO and he's always proposing more of a push in that direction, like footprint charts and things like that. But I thought he also did a relatively good job of discussing the profiles and how they can be used in analysis to provide some more insight. It might be a bit over your head. He's advanced, but he would be the one I would recommend if you want to learn more about that. All right, so we talked about the box, the weekly expected move. We were outside of the box. We have to have the consideration of, we're supposed to close in this box 8 out of 10 weeks or 80% of the time. And so, you had an 80% chance that price would come back in and close in this box by Friday, the end of the day. Well, it's not even Friday yet. And sure, we're back in the box, but price is already turning green and trying to come back out again. So we're in the range. This is the range that we were supposed to move for the entire week. We made it in a day and a half because we broke out of this thing Tuesday afternoon. It still implies that volatility is out of control, that they're not doing a really good job of pricing that volatility into the market, which is why we continue to expand beyond the weekly expected move. You're not going to want to do iron condors, butterflies, target plays, things like that. You're going to want to play expansion plays, but that is changing. If you keep track of spot gamma on a day-to-day basis, you might have noticed that the zero gamma or the spot gamma is down. It was at -3 and is now reduced to, let me pull it up so I get the number right. I don't want to misquote it. At last night, because we don't have the AM founders note yet, the spot gamma index was at 0.6. So it went from being a -3 to almost being a 0 this week. That shows that the negative gammas really decreased. Their interpretation of that decreased gamma when it's at a -4 -4 says that when price moves, it can make big moves. It's usually where you get these big expansion bars. And if it's a +4, then you get range more often, or that you get smaller moves. Now, generally speaking, when you get the good solid trend, you tend to get small candles, good, clean, uniform candles. Then things start to get out of control and you start to get big blowout candles. So it kind of makes sense. If we're going back to flat, then it's implying that these big sweeping move days that we've been getting where we really expand, even if, by the end of the day, we're back to where we started and didn't really do much. Say like here on Monday, that was a really big move. those can happen on those negative gamma index. But we don't have a negative gamma index. We're basically flat. Now, that doesn't mean that one of those days can't happen, just that the likelihood for it to happen is reduced considerably. As you would imagine, communication services are down the most, thanks to Facebook. We can also see that the Mag 7 is down, or the Fangs are down, whichever way you want to look at it. Nat gas. And really that's about all that's down enough to meet our criteria. But if we look at what's up this morning, we got gold miners, metals and mining. Got a little bit of China, but not enough yet. We would need a lot more at this point. We don't have any of the big ones that we need, like semiconductors, technology, the FANGs. But if you remember how we started this morning with the idea that the Russell was up, we could see some small caps, a little bit of a rotation today. So cloud computing, expanded tech, the Qs, those are all down. Semiconductors, nat gas, airlines, transportation got whacked hard yesterday. Take a look at the things that are up. The VIX is up. Gold miners, IWM, which IWM now is not yet up enough, needs another 5%. We can get to our benchmark 0.5%, but it's close. It's close enough to be keeping an eye on. I like this flat top with these higher lows here, kind of building a bit of like a bear pennant if we were reading it from all the way up here. If we're reading it from just this lower end, then we've got a minor little bull pennant. Think of that as the flag pull, if you want to look at it as a bull flag. But there's the pull, there's the pennant. Either way, whether we call it a pennant or a flag, it's compression. Now, compression is usually something that gets my attention, and I put a lot of focus and effort into it. But we're stuck inside of a massive candle, that April 23rd candle. Then inside of that, on the 24th, a smaller candle, but that's still a pretty big candle. And then now this yet again smaller candle. So it's good that we're seeing the smaller and smaller candles for the compression, but it's not like IX10 where you got a lot of excitement and you're looking for that big breakout play, because we're not stuck inside of a very small compressed range. We're just compressing at this point. We're not compressed yet. Russell will be worth keeping an eye on, though, especially if we're going to get a rotation. This is IWF, IWD, growth versus value, basically. And usually in the pre-market, it'll give a little bit of a heads up what kind of day. just be careful when you read it in the pre-market. I've seen it really gapped up in the pre-market, which would make you think bullish. And then, come to the open, there was no gap up. So this thing can be a little wonky, but I like looking at it in the mornings just to see if it's showing anything in the pre-market. And if it is, then which direction, up or down. This tends to move like the S&P, but you can also consider it like tech, growth versus value, right? So it's trying to think of it, the difference between consumer discretionary and consumer staples. That would be a way of looking at it, which there are different ratios that you can use, like XLY and XLP. Now, I have that one as well, but we don't really have a gap yet here. It closed at the low yesterday, and it's still there. Pre-market, we really haven't done anything. So maybe later in the morning, we'll get something out of either one of those two. If we look at the Mag 7, this is a homemade one where we got our own individual weights put in there and everything. We closed up here at 121. It's gapped down. Thanks, Facebook. But it's still holding above that 100. Now, this is just, again, like another ratio chart. By itself, it just is a reflection of the combination of NVIDIA and Facebook, Amazon and Google, all of them combined. So it's not telling us really more than we already knew. Fangs are weak and down because of Facebook earnings. Not much of a surprise. When it comes to ratios and things like that, this is a newer pair that maybe a lot of you haven't come across yet. FNGU is Fang up, just the up volume or uptick, versus FNG down, which is just the downtick. Now you can look at either one of those two charts individually on their own. What I decided to do was turn them into a ratio, one versus the other, instead of looking at each one individually. That's what this is. And as you would expect, it looks very similar to the Mag 7 or the NY Fang, but it's just another tool, right? This one, however, is differentiated because it does have just the up ticks and it does have just the down ticks, and you can chart them respectively. We've been talking about this divergence in the NASDAQ composite versus the CVI, cumulative volume index. Now, I mentioned that on this one, you can do all of the market for the US. On Thinkorswim, you can only do like NYSE, Amex, and NASDAQ. So it's pretty cool that if we wanted to, we could do all of it. And if I was looking at any other chart other than the NASDAQ composite, I would probably set it on all. But I want this thing set to the NASDAQ because I'm looking at the NASDAQ. The method to that madness. The reason I stopped here today is because we failed that breakout on the daily, kind of rolled over. So it looked like we were getting back in sync. We had this move up, and on this day, it's really when price started to move up with the indicator, but it stalled. We got a minor pullback, but in price, that green candle that is solid green shows that we closed lower than we opened, but we closed higher than the previous day's close, which is why it's green. We did close higher than the previous close, but we did close down lower than where we opened. That's why it's solid green. These are trend candles rather than just candles, right? That we're able to get more out of it, like hollow red versus solid red. So we took a bit of a pullback here in price, but we only took a very minor pullback in the indicator. It's worth keeping an eye on this to see if this indicator is going to continue to push to the upside, and if price is going to go with it, or if we're going to start to diverge again. On the hourly, we did get that breakout. The breakout is still true. We're keeping it, and it's flattening out here, but it isn't pointing down yet, as opposed to price, which actually pulled back. So a little bit of divergence there. It's really minor at this point. So you're going to want to continue to watch the clock, be prepared for the earnings announcement. I'm probably going to do a workup on Google. I'll take that back up. Google or Microsoft. I don't know which one I'm going to do, but once I get it worked up, I'll put it in the chat. If I can't find anything good, like a reasonably decent lotto, then probably won't do a workup. It's a lottery ticket, right? It's not supposed to be risk that's as big as a mortgage payment. It's earnings, so it's a coin toss at the end of the day. And if you've followed me for a while, you know that my track record with earnings are horrible. That's why I don't usually do earnings. I'm of the opinion that I am better off trading the pre-market or the pre-earnings ramp or the after earnings report rather than trading the earnings report itself, just because I completely suck at it. But that does leave, two other trades, the one before price gets to earnings and then the window on the other side of earnings. Those generally, to me, I have more success with. So we'll be working on Meta to add to the Netflix, since both of those so far have given us perfectly clear guidance. Now that they've reported on what we expect out of price, we'll work up something for Google and Microsoft on that as well. Be careful, be safe. I'll see you all tomorrow.